Welcome to Partner Perspectives, a thought leadership initiative from S&P Global that brings leading institutions together to examine the trends shaping global markets and deliver forward-looking analysis that helps market participants navigate uncertainty, identify opportunities, and anticipate what's ahead. This mini-series within the Look Forward podcast spotlights our first volume, produced jointly with Vanguard, entitled Partner Perspectives, The Future of Capital Markets, Unlocking Potential Ahead. Across 3 episodes, we explore the key themes at the heart of this research, including shifts in global market structure, index diversification, fixed income resilience, and the evolution of private markets. Leaders from S&P Global and Vanguard alike discuss what these changes could mean for investors, institutions, and the broader market ecosystem. Our third episode takes a closer look at the shifting fixed income landscape, covering how supply and demand momentum in bond markets are contending with a more fractured world, and how the right benchmarks can help investors stay on track. Having adapted to the end of the zero interest rate policy era, global bond markets are facing a new frontier of dynamics and transformations against the backdrop of uncertainty and volatility. Market buoyancy is being largely shaped by the tech sector, particularly with expectations for AI's disruptive potential. The digitalization of financial markets promises greater fluidity in capital movements, and the rapid growth of ETFs is adding a new layer of liquidity. Innovations in bond market infrastructure and the development of fixed income exchange-traded funds support longer-term market prospects. Our conversation starts with an exploration of the structural shifts that are reshaping the global bond market, with Alex Birry, head of credit research and insights at S&P Global Ratings, and Matt Chesham, executive director of equity and analytic products at S&P Global Market Intelligence. Their research highlights how cautious optimism for how innovation is laying the groundwork for greater efficiency and flexibility in bond markets, even if the journey remains complex and nonlinear. Then we dive deep into the technicals of benchmarking in bond markets with Jeffrey Johnson, head of fixed income product at Vanguard, to learn how bond index fund managers balance the need to maintain their benchmark alignment while capitalizing on opportunities during periods of market uncertainty. We're together to talk about how bond markets are changing, and although I'm eager to jump headfirst into discussing innovation in fixed income, I'd be remiss to skip the fundamentals. Starting with you, Alex, your team in S&P Global Ratings analyzes issuance, financing conditions, and other key risk indicators. Against the backdrop of our world in disruption, what is the state of the bond market today?
Geopolitics clearly dominates the conversation right now, and particularly the conflict in the Middle East. And I think markets are really grappling with uncertainty around the duration of the effective closure of the Strait of Hormuz and the potential impact on critical infrastructure. So all that really feeds into energy price volatility, and that has as well a knock-on effect on financial markets, including the fixed income parts. That said, I'd say it's important to keep some perspective. At the time of recording, the 16th of March, bond markets remain orderly and functional, even if the sentiment is a little bit unsettled. Global liquidity has proven resilient, and we are seeing that reflected in both the demand and the volume of issuance getting done. So certainly pricing has adjusted to reflect higher macro risks around growth and inflation. If you look at the 10-year benchmark yields, actually both in the US and in Europe, they're up roughly 35 basis points, give or take. So that's it. That pricing it's healthy. It's markets doing their job really, and we are increasingly seeing as well probably more selectivity, whether it's by geography, by sector, or rating category. I mean, of course, I have to say that this resilience isn't guaranteed, that's for sure. It will be tested depending on how the geopolitical situation evolves. But for now, I'd say that bond markets are showing composure. They are absorbing shocks. They are repricing risk, and they are continuing to function as a critical source of financing.
This context is crucial. You mentioned sectors, and I want to bring our conversation to that focus. Your research identifies that sector concentrations are surging amid strong bond issuance, particularly in tech and for AI investment. And since we came out with this research, we've seen risks play out in real time with AI-related software disruption across markets. Can this dynamic be considered an outlier specific to this industry, or is this the new status quo of credit risk and opportunities?
I mean, to set the context, you're right. Technology issuance last year represented about 17% of the total of non-financial corporate issuance. So that made it really the largest sector, on par with utilities, which traditionally is the dominant issuer. So tech now is very much at the core of the credit markets. You mentioned the recent AI related wobble in the software sector. I think what's interesting there is how quickly the narrative flipped. Just a few months ago, the debate was really about whether AI would live up to the expectation and how much productivity and automation it could deliver. And then suddenly the concern shifted to whether AI could actually disrupt or even substitute parts of incumbent sectors like the software sector, with therefore some strong implications on valuation. So is this dynamic an outlier? I don't think so. I think that first bouts of market anxiety and sharp volatility are likely to recur. We're late in the cycle. We're coming off a long period of market appreciation and very favorable funding conditions, but with increasingly narrow economic growth. And at the same time, we're also in a phase of material structural disruption, not just AI. I also mean the rise in private markets and crypto. And I think really those forces combine to create both opportunity and uncertainty. And I think for credit investors, it's a fine line between being vigilant and becoming unnerved. And I think it also means that selectivity matters more than ever.
Well, there's clearly more change on the horizon. With debt markets in this transition and in search of enhanced liquidity, what innovations around bond market infrastructure should market participants pay attention to?
I think when we talk about markets being in search of enhanced liquidity, that search can really take several forms. One is geographical, thinking of local bond markets, trying to unlock pools of domestic liquidity to diversify funding sources. I think that's been gaining momentum, but will be, of course, tested by the current conflict. Another one is more structural through the rise in private markets. And I think here the big question is not just growth, is what it would take for retail investors to safely become a systemic part of that ecosystem. If you think of transparency, liquidity, and risk management. And then there's the technological dimension. A lot of attention is focused on decentralized finance and the potential of blockchain technology. And really, for that to scale meaningfully, one prerequisite is missing. There's a piece that's still missing. It's really this bridge required between DeFi and traditional finance, or rather the other way around, i.e. the need for a reliable, safe, and widely accepted token that can really bridge those both worlds. And whether we're talking about central bank digital currencies, CBDCs, or stablecoins, I think these instruments really need to operate seamlessly between platforms and blockchains, really, so that we have real-time exchanges without trapping liquidity. And I think without that, we won't see any material progress in secondary markets. And as well, in turn, that means limited scope for primary issuance. And that's actually one reason why we launched back in December 2023 our stablecoin stability assessment, assessing really the stability or the ability of a stable coin to maintain a stable value relative to a fiat currency to see if they can play this role. Final point, I think I need to mention regulations. I think that's there has been regulatory progress in that context, particularly around stable coins in the US and Europe. But I'd flag that policy approaches do diverge significantly, with the US, for instance, leaning very heavily on stablecoins. China, on the other hand, focus more on CBDCs, and then you have Europe somewhere in between. So I think there are really a lot of signals to watch to understand how this evolves and also how quickly.
Alex, thank you so much for your incredible insight. Matt, I'm going to shift the focus over to you and your deep expertise because there's one innovation we have yet to discuss. A tremendous part of this innovation has come from the expansion of global fixed income ETFs, with their assets under management reaching $3.2 trillion as of December 6th, 2025. That's according to S&P Global's research. So, Matt, my first question for you. How do these exchange-traded funds work, and what's driving the growth of these products?
Yeah, sure. So when we talk about global fixed income ETFs, we're really talking about taking what used to be quite a fragmented dealer-driven bond market and wrapping it in a single tradable share. So if we think about it logically at a basic level, a bond ETF holds a basket of bonds that are designed to track a particular index or a defined strategy. That might be treasuries, global corporates, high yield, or a mix of bonds from several different sectors. All of those investments are then held in a single fund, the units of which are tradable like a single equity. Now, this instrument is subsequently called an exchange-traded fund, or an ETF for short. Investors can then buy or sell shares of that ETF on an exchange throughout the day, just like an equity. Behind the scenes, there are financial entities called authorized participants who usually consist of large financial institutions, people who play that role normally, or institutions who play that role normally, major banks, broker-dealers, and specialist trading firms, and they look to create and redeem shares in large blocks by delivering or receiving the underlying bonds, and that helps keep the ETF price stay close to the value of its holdings. Now, that seemingly simple structure solves a lot of the practical headaches of owning individual bonds, sourcing lines of illiquid issues, dealing with minimum lot sizes, or managing several different maturities or reinvestment strategies. The ETF does all of that in one trade, and crucially, it does it with intraday pricing and transparency that you don't simply always have if you're phoning dealers for quotes continually throughout the day. Now, the research piece that we're basing this podcast on highlights that bond ETFs facilitate diversified fixed income exposure without the operational complexities inherent in individual bond acquisitions, and that they enhance transparency, including through intraday pricing visibility, as I've explained above. Now, in terms of the actual growth story, I think that the numbers really speak for themselves. As you just mentioned, global fixed income ETF assets under management reached about $3.2 trillion as of the 6th of December 2025, and that's up from just $500 billion in 2016. So we've seen more than a five-fold increase in just under a decade. So really, in my opinion, there are a few key drivers that sit behind this impressive level of growth that we're seeing. So the first one would be a structural cost advantage. So bond ETFs tend to carry lower expense ratios than many traditional active fixed income funds, and the ability to trade on exchange can also help investors manage those transaction costs. Our paper explicitly cites that cost efficiencies, including reduced expense ratios relative to active management alternatives, is one of the core reasons that adoption has accelerated over the last few years. Now, one trade can also give you exposure to thousands of bonds across different countries, sectors, and rating buckets. So access and diversification is another key driver of this growth. Allocations across bond ETFs have broadened across treasury securities for core fixed income, investment grade corporate credit, and high yield instruments, and they've all been supported by attractive yields and fees as well. You could also look towards the flexibility in implementation because ETFs trade on an intraday basis. They've become tools not just for long-term allocation, but also for tactical moves. You see hedging of interest rate or credit exposure, and they also allow investors to adjust duration pretty quickly as well. In the market, you can see that there's also a blend of passive and active strategies that's now become available. Passive still really dominates at about 82% of the fixed income ETF market, but active bond ETFs are now a real genuine growth engine across the ETF landscape. Active AUM surged about 52% year on year to around $0.59 trillion, signaling that investor demand for strategic credit selection within ETF wrappers is a real thing and is a real driver of growth. So when you put all of that together, you've got a structure that maps very neatly onto what investors are actually asking for today, in my opinion at least. So you've got liquid, transparent, low cost fixed income exposure that still allows for that nuance in how risk is taken, and perhaps more importantly, in current market conditions, how risk is generally being managed.
You've identified that bond ETFs clearly have structural advantages, going as far to say in your research that these instruments are proving their value as essential components of modern investment strategies, offering unprecedented access, efficiency, and flexibility in fixed income allocation as the market matures. So now I'm going to challenge you with my next question. How has their development affected market effectiveness and investor accessibility?
Yeah, sure. So you quoted that line from the research about bond ETFs proving their value. And now, in my opinion, that's not just an exaggeration. It's a real summary of two big impacts. So how the market works and really who gets to participate. So on market effectiveness, again, in my opinion, there are a few clear channels to look over here. So bond ETFs add a bit of an extra layer of liquidity, if you like. So bond ETFs have created this additional liquidity layer, allowing investors to transfer risk exposure effectively without requiring transactions in the underlying securities. That's a line that comes directly from our report. So what that means is instead of everyone trying to trade individual bonds, many of which can often have variable liquidity profiles, they can transact in a single centralized instrument. Now that tends to smooth both price discovery, and it can also help to keep the overall system functioning better, especially when some of the underlying cash market can on occasion be quite patchy. So better price discovery and transparency. You can also see in our paper notes that the price discovery function of ETFs relative to underlying bonds has enhanced market transparency and efficiency in the overall financial ecosystem. Now, in plain English, that means that because ETF shares trade continuously, they provide a real-time signal of where bonds of baskets are clearing, which can then lead to informed valuations in the over-the-counter bond market as well. So that kind of leads on to the next step, which is more efficient execution for market participants. So you've got the combination of lower ongoing fees and the ability to execute in size on exchange. And I believe that, again, in my opinion, that's really enhanced market efficiency, particularly when you compare that to building or rebalancing bespoke bond portfolios one line at a time. When we look at investor accessibility, the change has arguably been even more profound. We talk often about democratizing the bond market, and the research is pretty explicit that bond ETFs have also democratized bond market access, providing enhanced portfolio construction capabilities for both retail and smaller institutional investors. Historically, if you weren't a big institution with deeper relationships, getting sensible diversification in bonds was difficult and pretty expensive. But now, with small ticket sizes, a retail investor can own a slice of pretty much any part of the global fixed income market. Because there are ETFs covering different duration buckets, credit qualities, and region, investors who previously could only hold a single bond fund can now also fine-tune their fixed income profile. For example, they can combine a short duration treasury ETF with an investment grade credit ETF to target a specific risk and return mix. And that's led to more nuanced portfolio construction across the whole investor base. We're also seeing improvements in the management of liquidity mismatches. They're being managed a lot more carefully. If you look in our paper again, it acknowledges concerns around potential liquidity differences between ETF secondary market trading and the underlying bond market depth, but notes that these are being increasingly well managed. Now, that evolution in how market makers, authorized participants, and regulators think about liquidity is, in my opinion, a bit of a sign itself of the market becoming more mature and effective. So really, their development hasn't just given investors a new product, it's also changed how risk is transferred, how prices are formed, and who can realistically access institutional grade bond exposure.
With this context and with this deep insight, I want to bring the conversation and connect it back to Alex's discussion of resilience against market volatility and the performance of credit markets within these dynamics. So your research also points out that ETFs have demonstrated considerable resilience across market conditions, and mechanisms are evolving to address potential stress scenarios. How do you anticipate their role and performance in the market to play out and evolve as geopolitical risk becomes the norm?
So look, I think the uncomfortable reality is that geopolitics has gone from being something that kind of brought around the occasional shock to recently a standing feature on the investment landscape. Our research describes global bond markets as showing resilience despite heightened policy uncertainty and a more fragmented geopolitical landscape, but it's also cautious that this resilience shouldn't be taken for granted. Now, against that backdrop, bond ETFs have a few characteristics that shape how they may behave. I think that they've got proven resilience across a certain plethora of different market conditions. Again, our report states that ETFs have demonstrated considerable resilience across market conditions, and mechanisms are evolving to address potential stress scenarios. Now, that's partly structural through the creation and redemption process and the presence of multiple liquidity providers, but partly practical as well, as the ecosystem has really learned from episodes of volatility that we've been through in recent years. We've also noticed that bond ETFs act as a bit of a conduit for risk transfer in stress markets. So in a world where geopolitical events can trigger these real big sudden shifts in rate spreads or cross-border flows, having one single instrument that allows investors to rapidly adjust exposure is incredibly valuable. Our paper notes that the rapid growth of ETFs is adding a new layer of liquidity, further transforming the dynamics of the bond market. Now, my personal expectation is that in future stress episodes, whether that's driven by conflict, sanctions, or trade tensions, we're going to continue to see bond ETFs acting as the first port of call for reallocating fixed income risk. We're also seeing a greater level of interaction with more digital and with a more digital and tokenized market. You can see the same section of the report talks about tokenization, digital bonds, and stable coins as emerging components of market infrastructure, moving us towards more real-time settlement, fractional ownership, and democratized access to capital. As these opportunities develop, bond ETFs could really start to plug into them. For example, being used more widely as collateral or traded on platforms with faster settlement. All of that is going to further support their role during geopolitical stress by reducing some of the operational frictions that would otherwise exist. But I say all of this, of course, with a bit of a need for cautious optimism as well. The authors collectively all very clear. Innovations, including ETFs, are really starting to lay the groundwork for greater efficiency and flexibility, but the journey is probably going to remain somewhat complex and non-linear, as we state. So in practice, I think that means that we should expect periods where ETF trading volumes and discounts or premiums to NAV valuations spike in response to geopolitical headlines. The structures are robust, but that's not going to make risk disappear. I think it's just going to make it easier to see, and probably it's going to make fixed income assets through bond ETFs a little bit easier to trade.
Matt, your forward-looking insight sets the stage for our final forward-looking question. To wrap up this insightful conversation, I'm eager to hear your respective outlooks on where these structural shifts will take us. Looking ahead and starting with you, Alex, what do you expect to materialize in the future to further transform the dynamics of the bond market and investing?
I mean, as you said, well, I think Matt was saying that he's a cautious optimist. I'd say I'm probably the same, cautiously optimistic about how innovation is laying the groundwork for greater efficiency and flexibility in bond markets. I think, as we discussed, both in terms of, well, at the same time, in terms of geographical shifts, structural shifts, and also technological. I think just for me, one longer term question is around trust. I think trust is really the underlying pillar of bond markets at a time of material changes and time of reduced appetite for globally coordinated policy initiatives. And I think for me, a key issue is whether markets themselves can establish governance, transparency, and standards needed really to sustain that trust and confidence and to support a durable acceleration of growth. I think for me, actually, the pace of additional innovation per se matters less than the credibility of the standards and frameworks that will sit around it.
Looking ahead, I'd try and link three items or three main themes from the research that together sketch out where bond investing might be heading in the coming months and years. So first, of course, I'm going to point out the continued growth and specialization of bond ETFs. I think the ETF footprint, as we've already said, is already large. And I think that you can see the paper also suggests that both passive and active strategies are going to remain important. I'd expect more granular products in the ETF space, targeting more specific sectors, factors, and duration baskets. I think we're also going to see further growth in active bond ETFs, where managers use the wrapper, but kind of lean into the credit selection, kind of curve positioning and securitized niches that can be offered through the ETF wrapper. Going back to Alex's point, I think the second digitalization of bond market infrastructure is going to be important. You can see in the report that it highlights this. It's quite clear that digitalization is going to be uneven, but ultimately it's going to increase liquidity. I think tokenized money market funds, digital bonds, and regulated stablecoins are all pointed to as some of the building blocks of a system that's going to be able to offer real-time settlement, fractional ownership, and a more democratized access to capital. I think for bond investors, that could mean perhaps shorter settlement cycles, and that would lead to a lower operational risk. I think you're going to see the ability to move collateral and manage liquidity intraday far more efficiently. And potentially you're going to have new forms of bond exposure that sit natively on digital ledgers, but are still anchored in those more familiar credit frameworks that we all know and love. I think third, there's going to be a broader, more diversified bond ecosystem as well. Our research paper talks about the development of domestic bond markets in emerging economies, which should, quote, improve and diversify corporates' access to financing and provide a buffer against external volatility. And I think that even though those markets will still need to strengthen transparency and supervision as they grow, if we look at combining some of those with the rise of private credit and the ongoing role of public credit, I think the menu for fixed income investors is only getting wider, from those more traditional sovereign and investment grade corporates to securitized credit, private loans, digital bonds, and kind of pretty much everything in between. So really, if we zoom out, I suppose the question is, where does that leave us? I'd say that we're moving towards a bond market that's more accessible for institutions and probably individuals alike, more modular as well, with tools like ETFs, digital instruments, private credit sleeves that can all be combined and used in very different but also very precise ways, and probably more dependent, a market that's more dependent on robust infrastructure and data, because as the system becomes more interconnected and more digital, the cost of weak plumbing and data is going to rise.
The forces shaping global credit markets are clearly profound. Shifting bond markets are offering the promise of greater efficiency and flexibility. Private markets are expanding and opening new avenues for growth. Tokenization and other innovations in the fixed income market are transforming how assets are created and traded, and AI is redefining how risk is assessed and capital flows. These developments are not incremental. Instead, they represent a systemic shift toward an even more data-driven and dynamic financial market ecosystem. Our partnership with Vanguard provides deeper insight on how the rapid expansion of exchange-traded funds in particular represents a new frontier for the global bond landscape. Jeffrey, in your research, you note that despite sounding easy, it truly requires a sophisticated approach to capture the risk and return of an appropriate benchmark through an index fund, and that bond index fund managers face unique challenges as compared to their equity-focused peers. What characteristics of the bond market create such complexities for bond index fund managers?
That's a great question, and one that we hear all the time. And the complexity really starts with the fact that in the US bond market, there are about 14,000 different securities in the Barclays US Aggregate bond index. Many of those bonds have limited liquidity. Many of those bonds are traditionally traded on an over-the-counter market, which means that a buyer and a seller needs to come together and negotiate a trade. There are cases where pricing transparency is limited, and all of these characteristics of the bond market require a substantially sophisticated approach, oftentimes leveraging technology and deep teams of experts to appropriately match the characteristics and then the returns of that benchmark. It's a process that we would liken to really requiring a blend of art and science.
The growth of bond index funds and ETFs are a clear indication that investors have an increasing appreciation for the structural advantages of diversified fixed income exposure without the operational complexities that are inherent to individual bond acquisition. So, from your vantage point, what is the current state of play amid uncertain and dynamic markets?
The growth of indexing in fixed income has truly been remarkable, but it did occur on a bit of a lag relative to the well-known growth that we've seen in equity indexing. Vanguard launched our first equity index fund, the Vanguard 500 Index, in 1976. It wasn't until 10 years later in 1986 that we launched the industry's first US bond index fund. And it took quite a few years for the popularity of bond indexing to really catch up. By 2000, there were still only less than 30 bond index funds in the universe. But over the last 25 years, we've seen an explosion in growth. There are now about 400 different bond index funds available. They account for trillions of dollars in assets, and roughly 40% of the assets in fixed income funds and ETFs. And even over the last 5 years, bond index funds and ETFs have accounted for about $4 out of every $5 that have gone into fixed income by investors. And we really think there are a couple big reasons why fixed income growth has been so strong. One of them has to do with fixed income index funds have really demonstrated that they're able to tightly track their benchmarks over time. And that's been battle tested through a few very volatile market environments. 2008, 2020, and 2022 come to mind, where bond index funds really proved that they could closely track their benchmarks, even in very volatile market conditions. Second big reason why I think fixed income investors have grown to appreciate the benefits of bond indexing is the cost. It is certainly an exposure now that investors can obtain in their portfolio to obtain broadly diversified exposure to fixed income through an index at a very low cost. And the Vanguard Bond Index Fund really leads the charge there at an expense ratio of only 3 basis points. That low cost is so important in fixed income, where your expected return on the asset class is a little bit lower than you would expect over time in other asset classes like equities. So that's why it's so important to just maintain as much of that return through a low cost for the investor as possible. And then the third reason why I think we've seen a big growth in the uptake of indexing in fixed income is that it is an asset class where there are abundant opportunities for active managers, and we're very much believers that active can work in fixed income. But some investors don't have access to the best talent or the best performing active fixed income managers. And for those who are looking to minimize cost, control their exposures in their portfolios, they now have abundant choices in a broad array of fixed income funds and ETFs that index the market.
But how are investors actually using these products?
That's a great question. And we see a few different types of investors approach to fixed income indexing. One very much resonates with the way that we see many investors use equity index funds and ETFs in their portfolio. They look for broadly diversified exposures, capturing the broad market in equities. That might be like something through the S&P 500 index. In fixed income, it might be through something like the Barclays US Aggregate Index, where they're establishing a core exposure and holding it strategically to gain exposure to fixed income over time. Another way that we see fixed income investors use indexing, though, has really been enabled by the growth of products and the growth of targeted, sometimes more narrow exposures in fixed income. What we know from working with investors for decades is that when they think about fixed income, many fixed income investors have very targeted needs or targeted goals or targeted time horizons or targeted risk tolerance. And this means that when they build fixed income portfolios, they sometimes show a preference for shorter duration index products or longer duration index products that might tie to their time horizon. Other investors have a clear preference for credit quality or yield, and they want to tailor the portfolio to meet their unique needs from a risk or yield or credit quality standpoint. And the good news for investors today is that they have hundreds of fixed income ETFs and index funds available that can help them gain very targeted exposure to the sectors of fixed income that are most suitable for them.
Let's move on from market dynamics to the importance of benchmarks as a measure of performance for the bond markets. How do managers actually align their portfolios to benchmarks like the Bloomberg US Aggregate Bond Index? How does this tangibly and technically work?
Sure. Well, it all starts with having a very deep and experienced team of investors who have really refined the approach to bond indexing over now 4 decades. This is an area where we've been managing bond index funds now since 1986, so a 40-year anniversary in 2026. It really requires a deep and experienced team. We have more than 50 portfolio managers, traders, and quantitative researchers that make up our bond indexing team, who specialize in covering and trading various sectors of the fixed income market. But it's not just them. We feel like a bond indexing effort really needs to be supplemented by very deep risk management expertise and resources, alongside a partnership with foreign exchange traders to the extent that we are operating in global markets. And then these resources are something that we have set up globally. So when you're trading in global fixed income markets and indexing global fixed income markets, it's so important to be operating in region and having the right kind of relationships and sources of liquidity locally in European markets, for example, or in Asia Pacific markets, where we'd also be looking to track benchmark exposures.
Your research also crystallizes that achieving tight tracking ensures that bond index funds deliver expected market returns, which can be especially critical when considering bonds typically act as a stabilizer against equity market sell-offs. This is particularly evident right now, given market volatility. That takes me to my next question. How do bond fund managers approach risk alignment and cost management in this pursuit of improving investor results?
Yeah, I talked earlier about how, we kind of think bond indexing is part art, part science. And this is really the scientific part. Again, as I mentioned earlier, there are about 14,000 securities in the Barclays US Aggregate Bond Index. It would be impossible to go out and replicate that benchmark. We have to take an optimized or sampled approach to mimicking the exposures of the benchmark. And to do so, we consider dozens of risk factors. We think of risk factors like credit quality and credit quality breakdowns, the maturity breakdown of the marketplace. We think of different sectors like corporate bonds, mortgage-backed securities, treasury bonds, and then we'll even go further and subdivide those sectors to try to build the broadest sample possible across all of those dozens of risk factors that help us control the tracking error relative to the benchmark. But there is a limit to how many bonds we really want to hold in that sample. One of the things that our research has found is that when you get close to about 80% or more of the benchmark, you've really found that sweet spot where you've maximized the amount of diversification that you have that helps minimize the tracking error relative to the benchmark, while also minimizing the cost and the transaction costs of holding and transacting in so many bonds. So that's kind of how we think about balancing broad diversification with the limits of where you might start to run into higher transaction costs.
So with complex events becoming more status quo than outliers, how can the very human elements and experiences of expertise and collaboration support managers in assessing risks, controlling costs, and taking action in their investment decisions and benchmark alignment?
Right. This is the art side of the equation to complement the science side of the equation. If we were to spend a day, an hour, a week on the desk of our bond index team, you'd see investment professionals that are responsible for managing passive portfolios or index portfolios. But what you would observe is anything but passive. They are making many active decisions every day to anticipate, respond to market events. And the thing about bond indexing is that, we always know where the index is today. So as cash flows emerge on a day in and day out basis, or rebalance activity takes place on a day in or day out basis, we're also thinking about two things. We're thinking about where is the benchmark today, but we're also thinking about where is the benchmark going at the end of the next month when it rebalances. We are mindful of new bonds that are being issued that are going to enter the benchmark, and thinking about how we can, in certain cases, in a very risk-managed way, proactively trade into those exposures. We're also thinking about bonds that are being downgraded and might be falling out of the benchmark. And what does that mean for how we might want to very prudently position ourselves ahead of those downgrades? There are also cases where lower quality bonds are upgraded and enter the benchmark. And we can see that with a little bit of advance notice before the end of the month. So these, in addition to a very dynamic market and economic environment, are all factors that our indexing team takes into consideration on an hourly and daily basis as they think about where is the benchmark today, but also where is the benchmark going.
To wrap up our conversation, a quote from your research report. You state that for investors, choosing a bond index fund that tracks its benchmark closely helps enable the fund to fulfill its role in a portfolio when that matters most. Jeffrey, I'd love to give you the last word in spelling out what this means to you and why, in Vanguard's view, this is so important.
Yeah, it really is critical. There are so many sources of uncertainty in markets that really is always the case. Here in early 2026, we're thinking about the impact of tariffs. We're thinking about some uncertainty geopolitically stemming from the Middle East. And there are certainly some questions around what that means for the future of interest rates and inflation. And for investors, our starting point is always just get the bonds in the portfolio. Bonds are so important as a source of diversification and ballast relative to riskier parts of the portfolio. And we're so excited about the growth of indexing for those investors who really have a preference for those kind of targeted or broad-based index exposures, which increasingly are available at a low cost and have proven through market cycles to very closely track their benchmarks. This requires a disciplined approach. It requires a very experienced team to do that. But in a dynamic environment, the right kind of disciplined and experienced team can really uncover pockets and opportunities of value as part of that process.
As you've heard from Alex Birry, Matt Chesham, and Jeffrey Johnson, precision in a shifting bond landscape is paramount as market dynamics and investor profiles evolve. This reinforces the clear message of our joint partnership, Partner Perspectives, the future of capital markets unlocking potential ahead. This is a moment of real transition, an inflection point, and the opportunities ahead won't be unlocked by any single participant acting alone. Infrastructure, policy, data, and market practice will all need to evolve, and that evolution will be shaped by collaboration. That's what makes this partnership between S&P Global and Vanguard so important, bringing together complementary expertise to offer clarity in a complex world, with insights designed not only to inform, but to help market participants channel knowledge into action. To learn more, read the full collection of research on spglobal.com. I'm your host, Molly Mintz, and this is the Look Forward podcast. Thanks for listening.